HSAs are some of the best retirement vehicles out there, we think, for tax-free growth. But can you really stockpile all of the money you put in an HSA and just plan to spend it later? We're going to analyze this today, how you'd go about doing that, and then what the risks are. So make sure to stay to the end to see what the biggest couple of risks are if you do this. Hi, I'm Matt Nelson, and I've been helping clients retire for over 25 years with Perspective 6 Group. And we set up this channel so that we could share what's working and help med tech professionals make smarter decisions with their money. So I've got Jacob back with me today, and we're going to tackle another financial planning and tax-related question. So a common planning question we get from clients is, how do you make use of your HSA plan? They might, they might have this great HSA plan through work. And the thing we see is that they're putting in the maximum, but then they're right away spending it by the end of the year. They're spending most of it, or maybe worse yet, they're not, maybe not quite worse yet, but not so great as they're leaving the balance, but it's sitting in the cash account earning nothing. So really, what we're trying to answer today is, can you just max out your HSA every year without pulling any money out for medical expenses? Is there anything wrong with that? And then if you do so, would that mean that you're going to build up this huge balance that would be great to spend tax-free out of retirement? But what if you don't? What's the kind of ramifications? So first of all, Jake, why don't you just review how the HSA plan works, and we'll go from there.
Yep. Let's go to the basics. HSA. So a lot of people, like you said, might use them, but not really understand what they're doing. So when you put money in an HSA, you're getting a tax deduction right away that year. For 2025, if you're on a family plan, you could put up to $8,550, and then you get an extra $1,000 if you're over 55. So that's quite a bit of money that you can stash away into these HSAs every year. And then once that money's in there, like I said, you get a tax deduction on the front end. And then it sits there and it can grow tax-free. You can leave it there for as long as you want. We'll talk about that here in a little bit. But you can also invest your HSA dollars just like you would your 401k. We'll also hit on that a little more to optimize it.
Yeah.
So tax deduction, tax-free growth. Go ahead.
Yeah, right. No, I was just taking the words right out of your mouth there. Yeah, you get the tax deduction on the front end, and then the biggest advantage of the HSA is that if you pull it out for medical expenses, it's tax-free. So very similar to an IRA in that way, that you're accumulating money on a tax-deferred basis, but the difference is it's all tax-free for medical. So it's kind of like a medical Roth in a way.
I love that analogy. And yeah, think of your Roth IRA, but for medical expenses. That's a good one.
So the kind of the point is, can you really stockpile the money and just, look at it later? And if you did, how big could that get? I think you ran right before the show, you were running some numbers. What did you come up with there?
Yeah. So yes, you can definitely stockpile it. Like I said, you can let this money accumulate through your working years into retirement. But that might not be the best thing, because it might get so big that you might never spend it all. So, on a 30-year period, let's say you're age 30 and you just started maxing your HSA out every year for 30 years until you're 60. If that account only earned 5%, your balance at the end of those 30 years is going to be over $500,000. Let's say that account grew 7%, which very well could happen. You might have over $750,000. That's a lot of money that you have to come up with medical expenses for, which is kind of one of the risks that we'll talk about.
Right. Yeah, it's like a catch-22. That's fantastic that all that money could be tax-free. But okay, so kind of the idea is, you mentioned investing them. So, should you invest them or just, leave it in the cash account? Well, these plans, typically, if you're familiar with them, they default to a cash balance, which is basically like a bank account, but you then can often push an amount over, typically $1,000 minimum, out to more of a brokerage account, or there's maybe a lineup of investments, just like there would be in your 401k plan. And then you can invest it in stocks or, stock funds, usually mutual funds, bond funds, etc. So, we recommend being relatively aggressive. I think that's okay, as long as you've got enough available to cover your deductible and you're not needing to access that. Because again, going back to the idea of we're going to let the stockpile, hopefully you're paying the medical expenses out of pocket. So yeah, being aggressive is probably okay.
And a lot of people think, "Oh, I'm retired. I'm going to be spending this money right away." Well, if you've been contributing to the HSA for a while, you'll probably have a big balance, and you're probably not going to spend all of it in one year. So leaving it invested even in retirement is okay to do.
Yes, right. And then we can treat it a lot like we do with clients on just their retirement income, whereas we get closer to the point we might spend some money from that account, maybe in retirement. We could start estimating the amount of medical expenses that might be there over the next, let's say, 5 years, and then start carving back and setting that aside in a bucket that would be less aggressive, and then use those for medical expenses if that's the plan. So, all right, what would you actually spend this money on if you did accumulate and it got to be a $750,000 account, and now you're age 65? What's typical expenditures?
Yeah, the first one that most people are going to have is Medicare premiums. So that's kind of the main one people think of when they think of HSA and retirement, is pulling it out, sending it to your Medicare to pay your premiums every month, which is great. Some other things like long-term care premiums or even long-term care costs, you can spend your HSA for those types of expenses. And then any other thing, whether it's a prescription drug or surgeries that you have to go to the hospital for, whatever, there's a long list of qualified medical expenses that you can spend your HSA dollars on.
Right. And including, I don't know if we added this to notes, but, really you need to keep track of all your receipts all the way up to retirement. As long as you have a receipt that was never reimbursed, there's no real time limit there on being able to reimburse for that receipt. And so if you're doing this correctly, if you're going to stockpile your HSA for years, then you got to stockpile your receipts for years. That is one of the risks. I mean, it's not like everybody needs another, bookkeeping item to keep track of, but keep the big ones, keep them in in some sort of digital file, and they should be available. For those of you that haven't, though, stockpiled all your receipts, for the most part, if you add up those Medicare premiums, long-term care premiums, it's going to be a pretty substantial sum anyway. And I think most people will probably have enough expenses to offset. I guess that kind of brings us to sort of our fifth point here is, what the risks are if you leave your balance untouched. So is there, how would you start to address that?
Yeah, I think like you said, most people aren't ever going to have a balance that is going to be too big to spend unless you are in that, rare scenario where you've just been maxing it out, have always had access to an HSA for 30, 40 plus years. The biggest risk though, like I think, is when you are not investing those dollars. That's a pretty big risk. But if you do max it out every year for 20, 30, 40 years, now you are at risk to maybe having too much in an HSA. And that's going to be less beneficial, because now if you went to spend that money just for, let's say you went to the grocery store and you drained your IRA already, well, you can use your HSA, but that's going to be taxable now and it's not going to be tax free. So if you fund too much where your Medicare premiums and long-term care costs are still below that account balance, that's a big risk. And then furthermore, probably the bigger one is, let's say you had an early death event where you really didn't spend any of your HSA and you didn't have a spouse that survived you. Those HSA dollars are going to go to your kids and they have to spend it all within 1 year. That's a way different scenario than if they inherited an IRA. They're not going to probably have enough medical expense that 1 year to drain an HSA most tax efficiently. So then a lot of that money is going to be taxable to them. And that's that's going to eat away at, could be half the balance. If they have to pull $300,000 in 1 year, that's easy 35-40% in taxes.
Yes, exactly. So it's a bit of a catch-22 that these HSA plans are, frankly, one of the best vehicles you have to save for retirement, because that triple tax-free nature, where you get a deduction on the front end, you grow a tax deferred, and it's spent for medical is tax-free. That is fantastic. Nothing else can beat that. However, the downside is if you don't spend it before you die, there are some risks that money is maybe even taxed, I shouldn't say less favorably, but causes more problems for heirs than it would in a normal accounting, say like a Roth IRA. I still think it's probably worth the risk for most people. A lot of the clients that we're working with, yes, maybe we are getting them early enough that they can start maxing out their balances and have a full 30 years to invest. But for the most part, by the time we're able to do that and you have enough cash flow to pay your medical expenses out of pocket and you can leave your HSA alone, you're in the higher earning brackets. Your kids have probably passed the, the constantly sick zone. And we're going to accumulate a sizable HSA balance, but we're not going to have $1 million in there typically. And if we're going to have a balance in the sort of 250 to 500 range, I think for most people, they're going to spend that on Medicare premiums, long-term care expenses, and so forth. But just keep in mind, the biggest item is if you're going to stockpile, keep your receipts, make sure that they're ready to go as soon as you hit retirement, or maybe years where you need some income, but you already have a high income bracket. Maybe you could tap into your HSA if it's a large enough balance then for some tax-free nature.
Yeah, that's a really good point. The reimbursement part of it with like no time horizon is a really key one to keep in mind and just store in your back pocket. So,
yep. Well, let's leave it there. It's all the time we have, but I think we kind of answered the question. It's definitely, you can stockpile it and it's worth it, but there are some risks. We'll link to in the show notes below a resource we have about how to evaluate your HSA plan. And if you want any second opinion, certainly give us a call and check out our website at perspective6group.com. And until next time, remember, financial freedom takes more than money. So find your purpose and make a plan to live your life well. Take care of each other out there.